What are the most profitable investments? Some things happening in the market today are unprecedented in history, but that won't remain forever. The Federal Reserve is still dependable and will bring inflation under control if you're a long-term investor. It's fair to be concerned about your investments, particularly in light of the recent sharp declines in the stock and bond markets. And starting an investment portfolio during such a volatile period can be unsettling. You won't lose out on any possible recovery, though, if you adopt an investment strategy that is suitable for your own financial circumstances and time horizon, and includes the appropriate asset allocation for you. The top 10 investments are listed below. Remember that decreased risk usually translates into lower returns. 1. High-yield savings accounts. Higher rates of return are offered by online savings accounts and cash management accounts than by regular bank savings or checking accounts. Cash management accounts resemble a combined checking and savings account. These accounts often come with debit cards or checks and may offer interest rates similar to savings accounts, however they are typically offered by brokerage firms. For short-term savings or money you only infrequently need access to, like an emergency or vacation fund, savings accounts are perfect. 6 withdrawals from a savings account are permitted each month. Accounts for managing cash have more freedom and often even higher interest rates. Keeping 3 to 6 months' worth of living costs in an account like this before putting more toward the investment items. Online banks typically provide greater rates than those at conventional banks with physical locations since they have lesser overhead expenses. Where to open a cash management account? Robo-advisors and investment firms, like Betterment and Sophie, offer reasonable rates on cash management accounts. 2. Certificates of deposit. A federally insured savings account with a fixed interest rate for a specific time period is known as a certificate of deposit, or CD. A CD is for money that you are certain you'll need at a specific future period, e.g., a home down payment or a wedding. With typical terms of 1, 3, and 5 years, CDs might be a smart choice if you're looking to safely grow your money for a certain purpose within a defined time frame. However, it's vital to keep in mind that you'll probably have to pay a fee if you want to withdraw your money from a CD early. Don't put money you could need soon, like you wouldn't with other investments, in a CD. The greatest rates on CDs, which are marketed depending on term length, are typically discovered at online banks and credit unions. View the current best CD rates according to term length and account minimums. 3. Money market funds. Money market mutual funds are a type of investment, as opposed to money market accounts, which are savings account-like bank deposit accounts. Your money purchases a collection of high-quality, short-term government, bank, or corporate debt when you invest in a money market fund. Money that you're willing to expose to a little bit more market risk because you might need it soon. Money market funds are also used by investors as a holding container for cash designated for future investments or to hold a portion of their portfolio in a safer investment than stocks. Although technically an investment, money market funds won't provide the higher returns and higher risk of the other options on this page. Growth in money market funds is more comparable to yields on high-yield savings accounts. Where to acquire a money market mutual fund? You can purchase money market mutual funds directly from a mutual fund provider or a bank, but an online discount brokerage will have the largest choices. 4. Government bonds. A government bond is a debt you make to a government organization, such as the federal or local government, that will pay investors interest over a predetermined time period, usually 1 to 30 years. Bonds are referred to as fixed income securities because of this consistent source of payments. Due to the U.S. government's complete faith and credit, government bonds are essentially a risk-free investment. Government bonds offer less of a return than other investment options in exchange for that safety. It would be significantly more difficult to reach your retirement or long-term goals if you had a portfolio that was entirely made up of bonds, as opposed to a combination of stocks and bonds. Conservative investors that favor a portfolio with lower volatility. Bonds are popular among investors who are approaching or have reached retirement because of their fixed income and decreased volatility. As these people do not have a long enough investment horizon to withstand sudden or significant market falls. Where to purchase government bonds? You may purchase individual bonds from a broker, bond funds, which contain a variety of bonds to offer diversification, directly from the underwriter investment bank or the U.S. government. You may choose which varieties to buy and where by using our guide to investing in bonds. 5. Corporate bonds. The main difference between corporate bonds and government bonds is that you are lending money to a firm rather than to the government. Since the government does not guarantee these loans, they are a riskier choice. The risk-return profile of a high-yield bond, also referred to as a trash bond, can actually be significantly higher and more similar to that of stocks than bonds. Investors who are willing to take on a little bit more risk in exchange for a fixed income security with possibly better yields than government bonds. In the case of corporate bonds, the yield increases with the probability that the company will fail. In contrast, the yield on bonds issued by established, major corporations would often be lower. The investor is responsible for determining the risk-return ratio that works best for them. Similar to buying government bonds, you can purchase corporate bond funds or individual bonds through an investment broker. 6. Mutual funds. In order to purchase stocks, bonds, or other assets, a mutual fund collects money from investors. In order to protect themselves from the losses of any one investment, investors can diversify on a budget by using mutual funds, which disperse their money across a number of different investments. Mutual funds are an easy method to access the superior investing returns of the stock market if you're saving for retirement or another long-term objective without having to own and maintain a portfolio of individual equities. Some funds restrict the types of businesses they can invest in to those that meet specific requirements, such as biotech companies in the technology sector or businesses with strong dividend yields. This enables you to concentrate on specific investing niches. Mutual funds can be purchased through their management companies directly as well as through discount brokerage businesses. Nearly all of the mutual fund companies we assess provide no transaction fee mutual funds, i.e., commission-free, along with tools to assist you in selecting funds. Be aware that most mutual funds need a minimum initial commitment of $500 or more. However, some companies will reduce the requirement if you agree to set up automatic monthly contributions. 7. Index funds. A sort of mutual fund known as an index fund holds the equities in a specific market index. In contrast to an actively managed mutual fund, which pays a professional to select the fund's assets, the goal is to offer investment returns similar to the performance of the underlying index. Some of the finest investments for long-term savings objectives are index mutual funds. Index mutual funds are less volatile than actively managed funds that aim to outperform the market, in addition to being more affordable due to reduced fund management fees. Young investors with a long time horizon may benefit most from index funds since they can devote more of their portfolio to higher returning stock funds than to more conservative products like bonds. Young investors who can emotionally withstand the ups and downs of the market might even do well to first invest their whole money in stock funds. 8. Exchange-traded funds. In that they pool client funds to purchase a variety of securities, exchange-traded funds, or ETFs, are similar to mutual funds in that they offer a single diversified investment. The way they are sold is different. Investors purchase shares of ETFs just like they would individual stocks. ETFs are a wise investment if you have a lengthy investing horizon, just as index funds and mutual funds. Additionally, because an ETF share price may be less than a mutual fund minimum, ETFs are the best option for investors who lack the funds necessary to meet the mutual fund's minimum investment criteria. Exchange-traded funds, ETFs, are a widely common type of investment that both amateur and experienced investors employ globally. ETFs allow you to invest in collections of assets in a single transaction and allow you to trade them like stocks on an exchange all day long. They don't come with a magic wand that will make you an investor success, but they do have some advantages that attract many investors. When you purchase an ETF, you make a single transaction involving hundreds or even thousands of distinct assets. An investor can quickly and simply create a portfolio that includes a variety of asset types and regions by using ETFs. You don't need a large sum of money to begin started with accessibility ETFs because they frequently offer extremely low minimum investments. With just a few hundred, you can begin assembling an ETF portfolio and add more as you go. You would have to pay your broker a commission each time if you had to go out and purchase each of the 500 stocks that made up the S&P 500. Because you just have to pay one brokerage charge when purchasing all 500 shares at once with an ETF, creating a diversified portfolio is substantially less expensive. Since liquidity ETFs are traded on exchanges, you can buy and sell them at any time. 9. Dividend stocks. Dividend stocks can offer both the growth of individual stocks and stock funds as well as the fixed income of bonds. Dividends, which businesses regularly pay to shareholders, are frequently linked to dependable, successful businesses. Even while the share prices of some dividend stocks may not increase as much or as quickly as those of growth-stage businesses, investors may find them appealing due to the dividends and stability they offer. Remember that dividends received in taxable brokerage accounts are taxed in the year they are received. Stocks, on the other hand, are subject to primary taxation only when they are sold. Any investor, from a novice to a retiree, can benefit from dividend stocks, but depending on where you are in your investing career, some may be preferable to others. Young investors, for instance, would be well advised to research dividend growers, which are businesses with a proven track record of steadily raising their dividend payments. These businesses might not currently have high yields, but if their dividend growth continues, they might in the future. This has the potential to produce returns that are comparable to those of growth stocks that don't pay dividends over an extended period of time. Stocks that consistently pay dividends may be an option for older investors seeking greater stability or fixed income. Reinvesting these dividends might not be the objective over a shorter period of time. Instead, taking the dividends as cash could be a strategy for investing in fixed income securities. Where to purchase dividend stocks? As with other items on this list, using an internet broker is the simplest way to purchase dividend stocks. 10. Real estate. In traditional real estate investing, a property is purchased with the intention of eventually selling it for a profit or being owned with the intention of receiving rent as a steady source of income. However, there are a number of additional, much more passive ways to invest in real estate. From getting a home loan to creating a nationwide real estate empire, there are countless methods to invest in real estate. Real estate investment trusts, REITs. Look into real estate investment trusts if you want to buy property right away and with the least amount of money possible, REITs. Like any other publicly traded firm, REIT stock can be purchased and sold on the market using a brokerage account. Because of this, REITs are among the most liquid real estate investments. Additionally, shares of exchange-traded funds, ETFs, that possess shares in numerous REITs are available for purchase.